Have you ever wondered how the stock market works? It can seem like a mysterious and complex world, full of confusing jargon and unpredictable fluctuations. Many people find the idea of investing both intriguing and intimidating. You might hear stories of overnight fortunes made and lost, leaving you both curious and cautious. The truth is, the stock market doesn't have to be a mystery. Understanding the basics of how it works can empower you to make informed decisions about your financial future. Whether you're completely new to investing or just need a refresher, this guide will break down the essentials in a simple and engaging way. We'll use relatable analogies and clear explanations to demystify key concepts like stocks, shares, and trading. Investing in the stock market can be a powerful tool for building wealth over time. By the end of this guide, you'll have a solid foundation for navigating the market with confidence. Let's dive in and uncover the secrets of the stock market together. We'll explore the fundamental principles that govern its movements and learn how you can participate in this exciting world of finance. Imagine a bustling marketplace, but instead of fruits and vegetables, people are buying and selling pieces of companies. This, in essence, is what the stock market is all about. It's a platform where individuals can buy and sell ownership in publicly traded companies. These pieces of ownership are called stocks or shares. When you buy a share of a company, you're essentially becoming a part owner, albeit a tiny one, of that business. Your ownership stake is proportional to the number of shares you hold compared to the total number of shares issued by the company. Think of it like owning a slice of a giant pizza. If the pizza represents the entire company, each slice represents a share. The more slices you own, the larger your portion of the pizza, and the greater your stake in the company. Just like owning a slice of pizza gives you certain rights, owning shares in a company comes with its own set of privileges and potential benefits. As a shareholder, you have the potential to earn money in two main ways: dividends and capital appreciation. Dividends are portions of the company's profits distributed among shareholders. Capital appreciation occurs when the value of your shares increases over time, allowing you to sell them for a profit. Section 3. Public versus private. Understanding the difference. Not all companies are listed on the stock market. Companies that offer their shares to the public are known as publicly traded companies. They are subject to stringent regulations and transparency requirements to protect investors. Private companies, on the other hand, are not listed on stock exchanges, and their ownership is not available to the general public. The stock market provides a regulated and accessible platform for buying and selling shares in publicly traded companies. It acts as a meeting point for buyers and sellers, facilitating the exchange of ownership and enabling capital to flow into businesses. In the next section, we'll delve deeper into how this fascinating marketplace actually works. Section 1. The role of stock exchanges. Imagine a bustling farmer's market, but instead of selling fresh produce, they're trading shares of companies. This is where stock exchanges come in. They act as organized marketplaces where buyers and sellers can connect and trade stocks. Think of them as the bustling hubs of the financial world, facilitating the smooth exchange of ownership in publicly listed companies. Some of the most well-known stock exchanges include the New York Stock Exchange, NASDAQ, and the London Stock Exchange. Each exchange has its own set of listing requirements and regulations that companies must meet to have their shares traded. These exchanges serve as platforms where investors can buy and sell shares of companies from around the world. Section 2. Matching buyers and sellers, the order book. Now you might be wondering how buyers and sellers actually find each other in this vast marketplace. This is where the order book comes in. It's like a digital bulletin board where buyers submit bids, indicating the price they're willing to pay for a stock, and sellers set asking prices, representing the price at which they're willing to sell. When a buyer's bid price matches a seller's asking price, a trade is executed, and the ownership of shares changes hands. This entire process happens electronically at lightning speed thanks to sophisticated trading platforms and algorithms. The order book ensures transparency and fairness in the market, allowing buyers and sellers to see the prevailing prices and make informed decisions. The price of a stock at any given time is determined by the forces of supply and demand. When there are more buyers than sellers for a particular stock, the price tends to go up. Conversely, when there are more sellers than buyers, the price tends to go down. It's like an intricate dance between those who believe a company's value will rise and those who believe it will fall. Factors that can influence supply and demand include company performance, industry trends, economic conditions, and even investor sentiment. News events, earnings reports, and economic data releases can all impact how investors perceive a company's future prospects, leading to shifts in supply and demand for its stock. To ensure a smooth and orderly market, there are designated entities called market makers who help facilitate trading. These are typically large financial institutions that stand ready to buy or sell shares of a particular stock at publicly quoted prices. They act as intermediaries, providing liquidity to the market and ensuring that there's always a buyer or seller available. Market makers profit from the spread between the bid and ask prices, providing a valuable service by ensuring continuous trading and reducing volatility. They help to dampen price fluctuations and create a more stable trading environment for all participants. Understanding the role of market makers is crucial for grasping how the stock market operates efficiently. The real intrigue lies in the constant price fluctuations. Why do stock prices go up and down? It's the interplay of supply and demand. Imagine a rare comic book becoming a sensation. Everyone wants it, but few are available. The price shoots up as collectors clamor. Similarly, in the stock market, positive news boosts demand. More investors want to buy shares. Demand outweighs supply, pushing prices up. Conversely, negative news leads to selling. Increasing supply drives prices down. Section 2. Company performance, a key driver. A company's financial performance forms the bedrock of its stock price. Imagine a bakery renowned for its delicious pastries. If word spreads about its mouth-watering creations, attracting long queues and boosting sales, its profits soar. This success reflects positively on its value, making its shares more desirable. Similarly, publicly traded companies release regular financial reports, offering a glimpse into their earnings, profits, and overall health. Positive earnings reports often signal growth and profitability, attracting investors and driving up demand for the stock. Conversely, disappointing financial results can trigger a sell-off, as investors lose confidence and the stock price takes a hit. Section 3. The influence of market sentiment and economic trends. Beyond a company's individual performance, broader market sentiment and economic trends play a significant role in stock price movements. Imagine a sunny weather forecast boosting the sales of ice cream parlors across a city. It's not just one parlor thriving, the entire industry benefits from the favorable conditions. Similarly, positive economic indicators, such as low unemployment rates or increased consumer spending, can uplift the entire stock market. Investors feel more confident, leading to a bull market where prices generally rise. Conversely, negative economic news like recessions or high inflation can dampen investor sentiment, resulting in a bear market where prices tend to decline. Section 4. A real-world example. Let's take the example of a fictional electric car company, Bolt Motors. If Bolt Motors announces a breakthrough battery technology, significantly increasing the range of its electric vehicles, this positive news is likely to excite investors. The perceived value of Bolt Motors increases as investors anticipate higher future sales and profits. This surge in demand for Bolt Motors stock, coupled with a limited supply of available shares, will push its price upward. Conversely, if Bolt Motors faces production delays or safety concerns regarding its vehicles, negative news could erode investor confidence, leading to a decline in its stock price. Opening the gateway, your brokerage account. Embarking on your investing journey starts with opening a brokerage account. Think of it as your passport to the stock market, allowing you to buy and sell shares of companies. It's like setting up an online shopping account, but instead of clothes or gadgets, you're browsing investment opportunities. Choosing the right brokerage is crucial, as fees and features can vary widely. Consider factors like trading commissions, account minimums, research tools, and customer support when making your decision. Reputable online brokerages offer user-friendly platforms and a wealth of resources for beginners. They often provide educational materials, investment tutorials, and even virtual trading simulators to help you get comfortable with the process. Investing in the stock market involves an inherent trade-off between risk and reward. Imagine a tightrope walker carefully balancing their steps to reach the other side. Higher potential returns usually come with higher risks, while lower-risk investments typically offer more modest returns. It's essential to strike a balance that aligns with your financial goals, time horizon, and risk tolerance. If you're investing for the long term, such as retirement, you may be comfortable with a more aggressive investment strategy, allocating a larger portion of your portfolio to growth stocks. However, if you have a shorter time horizon or a lower risk appetite, a more conservative approach, focusing on bonds or dividend-paying stocks might be more suitable. For beginners, starting with index funds or exchange-traded funds, often called ETFs, is recommended. Imagine a basket filled with a variety of fruits, representing different companies in the stock market. Index funds and ETFs track a specific market index, such as the S&P 500 or the FTSE 100, by investing in a diversified portfolio of stocks that mirror the index's composition. This diversification helps to spread risk and reduce the impact of any single stock's performance on your overall portfolio. Index funds and ETFs offer a convenient and cost-effective way to gain exposure to a broad range of companies without having to pick individual stocks yourself. Investing in the stock market is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Just as a gardener diligently tends to their plants, nurturing their growth over time, successful investors approach the market with a similar mindset. Before investing in any stock, thoroughly research the company, its financials, its industry, and its competitive landscape. Understand the company's business model, its revenue streams, and its growth prospects. Don't get swayed by short-term market fluctuations or emotional decisions. Remember that the stock market can be volatile in the short term, but over the long run, it tends to reflect the underlying growth of the global economy. Every seasoned investor was once a beginner. Take the first step, arm yourself with knowledge, and approach investing with a long-term perspective. Embrace the learning process, ask questions, and never stop seeking to expand your understanding. The stock market offers a remarkable avenue for individuals to participate in the growth of businesses and the global economy. Knowledge is your most valuable asset. Stay informed about market trends and economic indicators. Embrace the power of compounding returns. Investing is a marathon, not a sprint. Patience, discipline, and a well-defined strategy are your allies in building long-term wealth. Open a brokerage account, start researching, and consider seeking guidance from a financial advisor. The world of investing awaits. With the right approach, you can position yourself to participate in its potential rewards.